Hello and welcome to Killik & Co.'s 2016 predictions and themes. So just looking at the performance over the last year. So 2015 was a good year for global equities. Japan turned out to be the best performing market again with a total return of around 15%. In Europe there was also very good performance, so that saw a total return of around 12%. The US was impacted by the strength of the dollar as well as the impact of lower oil prices on earnings, and as a result the US only saw a total return of around 3%. In the UK the FTSE continued to be a poor performer with a total return of negative 2%, and this was after a pretty much flat performance last year. So let's recap on some of our predictions from last year. So last year we set a FTSE target of around 7,200. That obviously turned out to be very optimistic. We had based that on a earnings growth expectation of around 5%. That was lower than some of the other markets because of the FTSE's exposure to oil and resources. And what we actually saw was that oil prices continued to weaken over 2015. They were down around 40% from the level they were at when we made the prediction. And in addition, commodity prices also continued to weaken, and they were down on average around 30%. So this had quite a big negative impact on the performance of the FTSE, given that commodity exposed stocks make up around 23% of the index. This impacted the index negatively by around 8%. The other disappointing area of performance were the UK banks, large banks. Their concerns about regulatory changes as well as capital levels meant that they had around a 2% negative impact on FTSE performance, given they're around 13% of the index. In terms of our other predictions, so our 2015 don't be short prediction was for European equities, and that turned out to be a good prediction, which, as I mentioned earlier, there the total return was around 13%. Our one for the brave last year was for European banks, and just like in the UK, concerns around capital and regulations meant that performance there wasn't as good as expected. However, they did still have a positive return of around 4%. In terms of our expectations for this year, our FTSE target is 6750 for 2016, and that's based on modest global growth and divergent monetary policy as the US moves towards interest rate tightening cycle. In terms of earnings growth, we see the FTSE growing around 6% in earnings. This will be lower than other developed markets, again because of the exposure, the high levels of exposure to oil and resource sector. So that target represents around a 10% upside here, and that would leave the market trading on around 16 times forward earnings in a year's time, and with a yield of around 4%. And so overall, that's a total return for the market of around 14%. Then our don't be short for next year is emerging markets. And emerging markets has been an underperformer relative to developed markets this year, down around 15% year to date. And if you look out over a longer period, say around 5 years, it's been a significant underperformer at around 70% underperformance relative to developed markets. Some of the reasons why it's underperformed this year, well, there has been the anticipation of the US rate tightening cycle. There's also been relatively modest growth coming out of some of the large developed market trading partners. In China, the shift of the economy from being investment-led to being consumer-driven economy has resulted in weaker commodity prices, and this has affected emerging market profits as well as currencies. And then finally, the investor sentiment has been quite negative towards emerging markets, and this has resulted in quite large fund outflows out of emerging markets, particularly in the summer months of this year. So what do we think is the picture looking forward? So we expect emerging market GDP growth to begin to turn. We've seen about 6 years now of consecutive GDP growth declines, and the IMF is now predicting that this has bottomed out. Again, we believe that the outflows out of emerging markets look like they may now have bottomed out and are turning after the big outflows that we saw in the summer months of this year. In terms of valuations, emerging markets on a price-to-book basis have been trading at a discount now against developed markets for a while. However, they are at a very wide discount at the moment, at around 35% discount to developed markets. And looking at the valuation of emerging markets against historical basis, and this is looking at the cyclically adjusted PE ratio. So it's an attempt to take the impact of the earnings cycle out. And if you look at that, you can see that valuations on this basis are pretty much as low as they were at the depths of the global financial crisis. So what's our pick in this area? So our pick is for the Lazard Emerging Markets Fund. We believe its relative value investment philosophy means that it's constructed a portfolio where it has a higher profitability potential at lower valuations than the overall index. So the fund's characteristics, together with our overall positive stance on emerging markets, means that we are positive on this fund. Just moving on now to some of our thematic ideas that we'll be following in 2016. So one of our primary thematic ideas at the moment is the whole idea of technological disruption. This is basically how technology is disrupting the business models of almost every industry and changing the traditional way that businesses operate. So this results in the emergence of new competitors, and many of the existing players that don't adjust their business models may end up actually failing. So this technological disruption has been the basis of many of the sub-themes that we've spoken about over the last few years. So things like the mobile internet, solar energy, big data, smart industrial technologies, and mobile internet have all been driven by this theme. But we think the theme is going to get stronger over time. So if we look now at some examples of how technological disruption has impacted industries. So the first example is the music industry. So here we can see that in 2007, CD sales were around 4 times the level of digital music sales. And in 2014, they were around half the level of digital music sales. And you've obviously seen the impact this has had. The physical music shop has all but vanished from the high street. Looking at digital camera sales, so digital cameras, obviously, they disrupted film cameras, but now what's happened is the emergence of the smartphone has meant that digital cameras now are being disrupted by the smartphone, especially once the smartphones reached a quality level that was deemed accepted by most people. So you can see in this chart, the expectations for digital camera sales in 2015 is pretty much back below the level it was in 2003. Just a final example, everybody knows what Amazon does. Well, in the US, if you compare Amazon sales of general merchandise to Walmart sales of general merchandise, since 2007, Walmart sales have fallen by around 2%. And over that same period, Amazon sales have grown by 545% and now are running at over a third of the levels of Walmart sales. So a question a lot of investors might have is, isn't it priced in? Well, the fact is that technological disruption is happening at such an incredible speed and depth that most investors haven't been able to actually comprehend the impact this will have. And one way to consider this is if you look at the speed and size and cost of computing power by comparing the iPad Pro, which has been released recently, a large tablet, that has the same sort of computing power as a supercomputer would have had in 1990 or that a laptop had around 3 years ago. So we believe that many investors struggle to actually comprehend the exponential growth that's possible from technological disruption, and hence it's underappreciated in terms of the impact on share prices. So there's just a quote here from Bill Gates, which is very apt. So he says, we always overestimate the change that will occur in the next 2 years and underestimate the change that will occur in the next 10. Don't let yourself be lulled into inaction. And basically what he's getting at here is that it's often difficult to see that exponential change that is likely to happen, and as a result it isn't properly reflected into share prices. So just in terms of our stock idea that goes with this technological disruption theme, well, a lot of companies realize that they need to change their business model to compete in a digital world, but they realize that they need external help because they simply don't have the technological expertise. And we believe Accenture will be a winner in this space because it can bring together very deep industry knowledge that's developed in its consulting business, as well as very strong technological expertise that it has and strong relationships with technology partners. So it's driving this through its digital business. This is an area where it's invested a large amount of money over the last few years. It represents around 30% of its business and it's growing at 35%. So a very strong driver of growth. Just in terms of the types of things that the digital business would do. So they would help companies in interactive areas. So that's things like online marketing, setting up web stores, dealing with customers online basis. And here they've helped companies like Nespresso and Pizza Hut. They'd also help out on the mobility side. So this is effectively helping companies to construct mobile apps as well as the mobility platforms that link mobile apps into company systems. And Accenture is one of the largest app developers for corporate apps, having done over 1,000 apps across a variety of industries. And a final area that they will also do a lot of work is in analytics. That's basically helping companies generate and store and use large amounts of data. And as the world moves to more smart technology and more smart devices, more and more data is being generated. An example here is they've helped Thames Water with about 20,000 sensors to analyze the data that they're getting from these. So just moving on to our next theme, that's around auto technology. So it's a continuation from our overall technological disruption theme. And just some quotes. So the CEO of General Motors stated that the auto industry is poised for more change in the next 5 to 10 years than it's seen in the past 50 years. And KPMG, in their white paper called The Clock Speed Dilemma, said that manufacturing, marketing and engineering will no longer be the primary differentiators of success in the automotive industry. So here we believe that disruption is being driven not only by new technologies but also by regulations. And this increased technology means that there's much more use of software, and this is disrupting existing players in the market and also opening the area for new entrants to come in. So OEMs are going to face both new competition as well as increased costs and much tighter regulations. So we believe a better way to play this theme is through the suppliers that will end up benefiting from these trends. We believe that the auto technology theme will be driven by 3 industry megatrends. So these trends are the environment, so that's due to much stronger emission standards as well as consumer preference. Also safety, so that's driven by new safety standards and much tighter 5-star test requirements. And consumers obviously look at the test requirements when deciding which cars to buy. And also information that's led by consumer demand for having more connected cars as well as a move towards autonomous driving. So our stock idea in this sector is Continental. We believe it's got very strong positions in 3 areas. So in alternative powertrains, so that's been driven by emissions regulations and a move to lower polluting powertrains. There they've got very strong positions in hybrid electric powertrains as well as in gasoline direct injection. Also on the tyre side, there's been driven by emissions and safety regulations. So that's things like lower resistance tyres that reduce emissions and fuel consumption, as well as winter tyres. And then finally, advanced driver assistance systems. This has been driven by safety regulations, and here Continental has a very strong position across all categories in advanced driver assistance systems. And this is really where the big drive towards autonomous driverless cars is coming over the next probably decade. So just a few graphs to illustrate the point. So if you look at this in 2015, the grey and the light brown represent around 70% of powertrains. That's classic petrol and diesel engines. And if you go out 10 years, the expectation is that the market will have moved much more to direct injection, which is the two shades of red, as well as hybrid, which is the light blue color. And those are the two areas I said Continental has got a very strong position in. And also looking at the advanced driver assistance market. So in 2015, the market size is around 3 billion, and it's estimated that it will increase up to around 90 billion by 2025. Continental believes by 2018 their share of the market will be around 25%. So they've got a very strong position in this market, and it's a very fast-growing market. And as a result, we believe that investors haven't accurately valued this in the Continental valuation. So please contact your broker for more information about any of the themes or stocks mentioned in this presentation. And thanks very much for watching.